talk a little bit about the importance of avoiding companies with weak business models. And then we're going to look at a recent example and also relate it back to similar risk we're seeing in the market today. So this chart shows the share price of Nampak. Most of you will know it as a packaging company, and the management team will tell you about how they have world-class manufacturing facilities and blue-chip customers. But what very few people focus on is just how weak the business model is. The reality of this business is they are a price taker with very little bargaining power with their customers. They have a very high fixed cost base, which means they need the volume throughput through their factories in order to cover their cost. It's very capital intensive, and they actually need to inject debt into the business in order to make the returns work. So just to look at how capital intensive this business is, if we look at the cumulative capex spent since 2011, they've had to invest 11 billion rand into the business. So some of it went to driving efficiencies, some new plants, but a lot of it was actually just to maintain the current facilities. And all of it was funded through debt. So we saw net debt to equity going from close to 10%, which is moderate in 2011. It spiked all the way up north of 200% in 2023, and they were forced into a rights issue. Now, all this capex spend, what did it deliver to shareholders? We can see the accounting earnings from this business has been fairly muted up until 2017, and then the wheels just came off completely. But there has always been warning signs for investors. If you look at the free cash flow in 2013, it turned negative, and it's always been below the accounting earnings ever since. So the cumulative free cash flow from this business since 2011 is actually 3 Rand per share. And that's for a business that in 2014 was trading at 80 Rand per share. So a very big difference compared to the accounting earnings they presented to shareholders, which was closer to 16 Rand per share. Still not enough, but it's a figment of their imaginations. It never existed. So if you have high investment and you do not see the earnings follow through, eventually reality sets in and you need to impair your assets. And then the true economics of the business starts to be reflected. So we've seen these cumulative impairments writing off 100% of all the capital they invested since 2011 up until 2023. So anyone who claimed the business was trading at a significant discount to its assets, the impairments followed, and it turned out it wasn't real. Anyone who pointed towards a low price to earnings ratio, there was never any cash flow, and it turns out that was also not real, and the pain was borne by the investors. So going to a similar example today, so this is Sasol, lots of similarities. The share price has sort of been bobbing around along for quite some time, and it's recently come under pressure. But the business model, again, is extremely weak. They are a price taker, they sell a commoditized product, they're very reliant on the price of oil and also on chemical prices in order to generate revenue. It's a high fixed cost business, it's extremely capital intensive, and they're also injecting debt into it in order to try and make the returns look better. So from a capex perspective, this is what they've spent cumulatively since 2011. 554 billion rand has been invested. Some of it has been new plants, new plants and projects, and also a very large portion of it has been sustainable capex, just to maintain the current facilities. And again, they've injected debt into the business. It went from net debt to equity of 15% in 2011, which is manageable, all the way north of 95%, where they're sitting currently. And for all that investment, they've received nothing. The incremental uplift in earnings, even accounting earnings, is lower today than it was in 2011. And again, the real number to focus on is that free cash flow number. So cumulatively, free cash flow from Sasol since 2011 has been 20 Rand per share. The accounting earnings cumulative is closer to 540 Rand per share. And that big differential relates to the depreciation charge. What they put through the income statement is close to 16 billion Rand that they claim they need to maintain the assets at, but the real maintenance capex number is closer to 32. So vastly overstated earnings, and what really matters is the free cash flow. So again, today we hear people talking about it's trading at a discount to its assets and it's a low PE. We don't believe it's real. Here's the cumulative impairments they've had to incur, writing off 42% of all the investments they've made since 2011. All of that's good. Where are we today? So this is just a very simple sensitivity chart to show the free cash flow from the business that they'll generate at various oil prices. So if we take the current oil price, which is $70 per barrel, we think they'll do around 2 Rand per share in free cash flow versus a share price of close to 100 Rand. So definitely not an enticing number. And unless we see the oil price actually go above the $85 level, we think the business and its balance sheet and its ability to service itself is under real pressure, and plain could very well follow. So in conclusion, we're very cautious of businesses with strained business models, and we think investors could end up paying a very high price for what appears to be an optically cheap share, and we'd rather stay well clear.
Okay, thanks, Wim. So now you've outlined a number of characteristics that we look at in businesses that we avoid. Perhaps you can give us some examples of the opposite of that, some businesses that we feel are compelling today.
Yeah, it's interesting. As an investor, you never know what comes across your desk. But recently, we've seen the Boxer IPO coming to market, and we think it's a very compelling opportunity. So they are almost the inverse of a Sasol. They have a negative working capital cycle. It's very capital light in terms of rolling out the stores. The free cash flow is extremely attractive, and they generate returns on invested capital north of 40%. On top of that, it's in a defensive industry. So food retail, we think we've got a fair understanding of where the business will be 5 to 10 years from today, and they've got a long runway still for growth ahead. So much rather be invested in a company with certainty where we believe we got a handle on the future than something that's very tenuous like a Sasol.
Okay, so Wim, these are all very much bottom-up sort of criteria that we might consider at a fundamental level. Let's switch tack a little bit and look at the overall environment. How has the formation of the GNU and the potential uplift that we may see, hopefully, in terms of economic growth, how does that influence the type of companies that you'd be looking to buy?
Yeah, there's a lot of optimism at the moment that the GNU will lead to better economic growth. We're not that sure. We think it could transpire, but our preference remain very much for companies that do not need economic growth in order to deliver for shareholders. So we're more focused on high free cash flow businesses that are well positioned, that can continue to take market share and continue to deliver for shareholders, whether we see GDP growth at 1% or 2.5%. We think there's some ice cream to be had if we're off to the races, but we rather continue to play in the high quality space.